SJS Markets. He joins us now from Hong Kong. Good to see you again, Dariusz. What did you think about the ECB post-meeting statement from Trichet in terms of when we can expect the next rate cut from the ECB and whether or not they're getting in front of the curve as they should?
Trichet clearly suggested that at the February meeting there will be no rate move and that the next time they may cut would be March. So this was quite a disappointment to the markets, which first expected a bigger reduction yesterday and were hoping for a follow-up 3 weeks from now in February. The ECB clearly is still behind the curve and not realizing that they are pretty much the only people in the whole world who don't know that the European economy is in a huge trouble and that probably there will be deflation in the summer. So staying behind the curve and killing growth in the Eurozone much more than they actually need to.
But I'm sure he's a highly qualified, highly intelligent man, Trichet, and all of the other central bankers in the Eurozone. So what's holding them back? What is it specifically that, for example, they cite as to why they can't be more aggressive in cutting rates?
I think it's a culture of consensus building within the ECB Council. Various economies have recently performed at various sort of paces, moving down, and some of them, such as in Germany, have a strong anti-inflationary bias, which prevents the entire body from moving aggressively enough. And also you have to remember that European culture is generally averse to making dramatic moves. But again, I think it's detrimental to what's happening in the economy and also detrimental to the value of the euro.
Detrimental to the value of the euro. So how far down do you think the euro might be pushed as a result of this dilly-dallying?
I believe that the delay with which they are cutting rates is going to hurt growth rate differentials for the Eurozone so much that we are going to see euro-dollar going down to the low 120s in the spring.
120s in the spring? Okay, so how would you, if you wanted to play this, if you wanted to play the euro weakness that you're seeing there, Dariusz, what would you play it against? Specifically the US dollar, or is there another currency that might be a better cross?
I think that playing it against the US dollar would be the smart thing to do because the American economy is the one that will emerge from recession first due to very aggressive monetary and, more importantly, fiscal stimulus. So in the spring and early summer, it will become quite apparent that the US will be pulling the entire global economy out of recession and the rest of the world will follow with some delay, which will be beneficial for the greenback. So the euro-dollar cross going down, I think, is an attractive proposition despite the steep decline so far this year.
So from what you're saying, it sounds as if you're not in the camp that is predicting a collapse of the US dollar this year.
I don't think that the US dollar will collapse in the first half of this year. However, towards the end of the year, the rest of the world will begin catching up with the US in terms of economic performance because strong demand generated by US fiscal stimulus will revive exports to the US from other countries. So towards the end of the year, the situation will completely turn around and the dollar will come under severe pressure, and not in the least from the widening of its current account deficit. So by the end of the year, I think that the euro-dollar will actually recover to 140.
Okay, so some wild swings then for that pair, the euro-dollar pair. Dariusz, we'll talk more about the US economy and what's going on out there in the globe. Us live from Hong Kong. A moment ago, Dariusz, you were saying that your base case scenario is that you expect the US economy to recover in the second half of this year, thereby hopefully dragging the rest of the global economies up with it. But my question to you is, we were talking during the ad break and you said that you expect the Chinese economy this year to only clock in at about 5% growth. So for Asia, which is more important these days, a recovery in the US economy or a weak Chinese economy?
I think that both are very important. However, the recession in the US is so dramatic that it has a bigger impact on Asian exports decline than slowdown in China. And therefore, it is somewhat more important for our region to see the success of Obama's stimulus package than the success of Chinese policymakers in limiting the slowdown in their economy.
Why do you think the Chinese economy will slow down to 5%?
The key reason for that is the external balance. China became extremely dependent on their growth, on increase in external surplus. And this year, due to collapse of demand abroad, it will shrink substantially, we estimate by 60 percentage points, by 60%, which would chop off 4 percentage points of their growth. As far as domestic demand, there will be a shift between fixed asset investments stimulated by the government, which will grow a lot, and those that are sort of secular private ones, which will almost stall, especially in infrastructure, and also some slowdown in consumption. On balance, domestic demand growth, thanks to the government spending plan, will not slow that much.
What do you think will happen, therefore, to intra-regional trade? Because I remember last year, as the U.S. economy was clearly moving to be the first into recession, people were saying, don't worry, we've still got China. Don't worry, commodities will hold up because we've still got Chinese demand. Well, all of those pillars have been broken down gradually over the months, haven't they? So what do you think the rest of the Asian economies need to do now to prepare for the fact that the Chinese economy might slow down to 5%, maybe less? We just don't know.
At this point, it's too late to prepare for that, and Asia will have to fall into a deep recession. I believe our region will suffer the most out of all the global economic areas because we are the most dependent on exports. So what regional economies have to do is to act the same way that China and the US are trying, by stimulating domestic demand through very aggressive fiscal policy easing. Korea is an example of a country that has understood that and is really being very aggressive, but other countries not so much, and therefore there will be very steep recession pretty much in all economies, and the ones that will be hit the most will unfortunately be Singapore, where you are, and Hong Kong, where I am, due to our dependence on international trade.
I was in Singapore. I'm now in Sydney.
Oh, I'm sorry. Yes,
Derek,
we are in Sydney. Yeah.
That's okay. Derek, let me just pick up on what you said about Korea and its aggressive response in your words. What does that mean in terms of your strategy for the Korean won?
The Korean won is sort of very dependent on global sentiment due to the high external debt of the country, and due to the risk that if credit crunch deepens, then there will be troubles with refinancing of this debt. My bet is that there will be gradual improvement in terms of credit crunch and also overall market sentiment throughout the year, which would be favorable for the won because it fell so much last year. And my target for the end of the year is 1250.
1250. We're currently at 1373. Derek, always good to have you on the show. Derek Kowalczyk, Chief
My
Investment
pleasure.
Strategist with SJS.